runs one of the city's best performing gilt funds, and he had been suggesting a few weeks ago the gilt market might have been oversold. But what about now? Joining us for more, Ian Williams, fund manager at City Financial Investment Company. You came out with a remark 3 weeks ago, and we did indeed have a bit of a rally since then. Ian, where are we now?
We're probably neutral at the moment. I mean, it's unlikely in the very short term that you're going to see major moves in the gilt market one way or the other. It's probably bedded down now for its annual run-in for the end of the year, and I wouldn't expect too much to go on one way or the other, to be honest.
I mean, it has been sort of an extraordinary year, I guess, to be a gilt fund manager, you know, with this process of quantitative easing, 200 billion being bought still by the Bank of England. I mean, it's a sort of market you couldn't really lose, is it?
Well, most gilt funds are down on the year, or they're not doing very well this year.
They've got a buy like the Bank of England stepping in every week.
Well, because if you go back to January and February, long-dated gilts fell quite sharply in January and February, and a lot of the funds never quite recovered from that. So even despite quantitative easing and the sort of rally that it's engendered, a lot of those funds still haven't recovered what they lost in January and February before quantitative easing kicked in.
We've had comments out from Mr. Fisher, who's a member of the MPC today, saying all options are still open for QE in February. So how do you judge your investments with that in mind?
Okay, well, we went on record saying that we wouldn't rule out negative interest rates in the UK, Swedish-style negative interest rates.
And they talked about that in the minutes this week.
And they did indeed. And the reason we were saying that is we don't think that the Bank of England's going to go there with a public sector deficit the size they're running. But if there was a deal where fiscal policy was tightened quite sharply, you can't tighten fiscal policy sharply without sending the economy probably back into recession. So you need a balance. And we think that if the MPC saw a plausible deal on fiscal tightening that was believable and was big enough, that they would respond with a further monetary easing. Now, how do you ease monetary policy when interest rates are 0.5%? You either go to 0.25% or maybe virtually zero, or you may even go Swedish-style negative. But I think they probably would want to see some sort of movement on the fiscal side before they go down that road.
I guess a couple of interesting points, and from an investing perspective, it suggests that the 2-year area of the gilt market is still reasonable value, and is that, I guess, a piece of advice that you might be proud to offer to viewers?
Yes, because anybody sitting with cash in a building society deposit account or a bank account is getting virtually nothing. So if the outlook for the economy is sufficiently negative, then there's no real danger that interest rates are going to go up. There's a sporting chance there may be even further monetary easing. So some of these lower coupon short-dated gilts, 2014, 2015 gilts that are below par, quite tax efficient for private investors to buy, are much better than holding your money in cash. Yeah.
And thinking about who benefits, I mean, you identified the great rip-off of the depositors in the UK as this policy passes through, and there is a sort of carry trade that the banks are engaged in, you know, where they are borrowing from depositors at tiny little rates and then lending back to the government at great big fat margins. Presumably, therefore, this is quite bullish for the banking sector.
Well, I mean, you've had an enormous rally in some of the bank shares, so you have to question how much of this is already discounted in the shares of the banking sector. I mean, this whole recovery, I mean, it's been our view for a while that this whole recovery is a long-haul story. It's not a short-haul story. And we think that the UK economy, because of the fiscal tightening that has to take place, I mean, both governments have said that they're going to tighten fiscal policy. So if the Conservatives win the election or the Labour get back in, they're both on track saying they're going to tighten fiscal policy.
Absolutely.
Labour will probably tighten it by looking to raise taxes more than cut spending. Conservatives will probably look to cut spending rather than raise taxes. But they're both on it. The EEC are on the case. They've virtually told them under the Maastricht Treaty they've got to tighten fiscal policy, and the bond-rated agencies.
Will there be any need for the coupons on new issuance to be higher? Do you think continue to attract money once the Bank of England stepped away from QE?
It depends how the outlook for the economy unfolds, because if the economy is still weak, they can get away with selling gilts at roughly the current coupons, maybe even lower ones. But if the economy if this all goes the other way and the economy suddenly rebounds, that's when you're looking at the danger for the gilt market, when it looks like the economy is going to sharply rebound. We just can't see that happening at the moment.
But there is a risk, if one thinks about the other perspective of what's going on here, that people say, well, actually, the UK is a basket case. We don't want to be in the pound. If we don't want to be in the pound, we don't want to support the gilt market. When one thinks about who's been the marginal buyer of the gilt market, there's been this enormous dependency on non-UK investors being paid to fund our deficit. How do you think the non-UK investors will be looking at the market right now?
Well, if say this all transpired and we went to negative interest rates, then there's a reasonable bet then that sterling will fall relative to other currencies, because I can't really see that there's a strong case for negative interest rates in a lot of other currencies. So if there was a monetary easing in the UK that wasn't matched overseas, all other things being equal, sterling would fall. If that happened, what would be the effect on foreigners who hold gilts? Well, they'd probably come in as buyers, because what tends to happen? People always think that strong sterling is good for gilts and weak sterling is bad. Actually, in fact, most of the time it works the other way around. So what you find is sterling suddenly dropped, you'd have loads of sovereign wealth funds who don't particularly like the dollar and US treasuries either and looking to diversify. If sterling suddenly cheapened up, it's a lot more likely that you'll get big foreign buyers into the gilt market, i.e. they buy sterling because they think it's now gone down and it's quite cheap relative to something else, and then having bought the sterling, well, what do we do with this foreign? Oh, well, we just stick it in the gilt market.
Presumably buy the short end of the...
Yes.
They buy short paper, right?
But you see, I think I'll draw a distinction between the absolute levels of when we've got sterling cheap and the process of change. And I think the process of change where people say, well, the pound's going down, we don't want to be that, I think that's going to be a really difficult challenge.
Yeah. But some of these, if you were running a sovereign wealth fund in the Middle East or the Far East, you haven't probably got a huge exposure to sterling. You're much more worried about your exposure to the US dollar and what's going in there. So sterling, to a certain extent, is a bit of a sideshow. So you wouldn't necessarily look to sell sterling because you're not particularly overweight in the first place. You're overweight dollars and far more worried about what's going on there. So if sterling suddenly cheapened up, you're more likely, in my opinion, to come in and maybe look to add to it.
I think we just found out what Ian's sales strategy is going to be when sterling weakens. I think we've went out. Good to see you, Dave. Thanks very much, Steve, for joining us. Fund manager at City Financial Investment Company.